individuals typically, and homeowners. If someone doesn't own a home, it's very unlikely that they're gonna be able to itemize. Schedule A is what you use for itemizing, that hasn't changed, you still use Schedule A. And TaxSlayer, of course, will generate this for you. When you choose to itemize in TaxSlayer, it'll give you all these boxes to start populating these things. But there are limits to all of this. So, first one, medical and dental. The rule is now it must be over 7.5% of their gross income for them to itemize medical and dental expenses. So for people that's a lot, but that covers transportation, their health insurance premiums, prescriptions, long-term care insurance, any kind of mental health, doctor's bills, hospital's bills. But it has to be, but before you can itemize, it has to be more than 7.5% of their gross income. So 2018, going forward, home mortgage interest, so home mortgage interest, that stayed the same. They get a home mortgage interest form that they'll have, and they'll bring it in, and it'll show how much they paid in interest for the year. You'll just plug that in. Taxes paid, they can itemize, so property taxes, state and local taxes, real estate taxes, all those types of things, and that actually has been, 2018 going forward, that's capped at $10,000.
So they can only take 10,000 on that line.
Yep, and anything they paid over that, they can't take for that. Gifts for charity, like we were saying, that's about the same. I think it's a 2% floor for gifts to charity.
50%
Yeah.
gives to charity.
Yeah, but it's a 2%, like it has to be 2% of gross income before you can start. No. Limits it at 2%.
No.
Is miscellaneous the 2% floor?
Yeah,
Sorry.
Miscellaneous.
Never mind, never mind. Gifts to charity, sorry, I was
50%
confused.
though is, you can't give over 50% of something.
Yeah,
50% of something you can't give.
I think the home mortgage
60.
interest, I remember, if you're grandfathered in, for any type of loan, you can kind of, if the home mortgage was taken. But if you took a loan in 2018 for more than $750,
yeah, so
There's
I
a
didn't
cap.
even put that in here because if you run into someone who's taking out a $750,000 home
They should-
loan, they probably
You shouldn't be buying.
it would be
Should
coming
be.
by.
But yes, so it was $1 million and now it's 750,000.
Wasn't there a PMI or something that went in with your home mortgage interest and points?
There used to be.
I think PMI, I think that's what it was called.
Private.
I don't know, they
mortgage
didn't talk about
I think
it.
that went
Yeah.
off.
Okay,
I don't know.
That's something that the mortgage companies require,
Yeah.
and it's to their benefit.
Isn't that some type of insurance, like if it doesn't
Yeah,
value
it's-
enough
yeah.
or something?
Principal mortgage insurance.
To make sure
It-
they can
Yeah,
pay.
but I don't think it's deductible.
It used to be,
Yeah,
but
I
I
don't think
think
it's
they
deductible.
took it off this year.
yeah.
Check that out. Not now.
No, I mean,
It'll be in the
No,
fall.
not now. We're not gonna see any of it anyway.
yeah, it's just crazy too because it's like, there's so many changes. Like I haven't even gotten into the section about the changes yet. And so, luckily you can rely a lot on TaxSlayer. The system.
Looks like you have to order dinner.
Yeah. No,
Now,
we're making great time.
the gambling losses, that's still on.
Yep.
All your miscellaneous deductions went off though this year.
Not all of them, but a lot of them did. So
Your
union dues
2106,
Tax
union
payers.
dues, tax credit.
gone. Yeah, so a bunch of miscellaneous deductions are gone. The gambling winnings is still.
Yeah.
Well, that's-
The 2106, that's mileage for people that don't do Schedule C.
Yeah.
And their extra, that went totally, I think. That's gonna be a big one for some people.
Yeah, I haven't, yeah, let me see here.
Did you ever read one of those 2106 and write like Schedule A?
I don't remember.
Well, that's.
Does moving come under miscellaneous?
Hmm?
The moving expense come under miscellaneous?
No, that was 3903, that's totally gone.
They took that out too, didn't
Yeah, they took that out, except for the
Would be
military.
gone for military also.
No, military, I think it's
Yeah,
staying in, but everybody else is not.
I don't do military anymore.
I don't know, my internet's not working.
That's all right, we won't see that many anyway, but. it
Yeah,
is-
I mean, if you.
That will be a big
If you
one for
guys
some people.
itemize, yeah, but again, I don't know that you're gonna find people that can itemize $12,000, you know?
It's very difficult.
I've seen $7,000-8,000 go down on that line before, not with this, but others.
But, oh, well, yeah, of course, but I'm saying for
Yeah.
us, but, okay, so I know you can deduct the gambling losses still.
You could take their mileage
Oh,
and other business expenses.
Mortgage interest, we talked about that.
so like my grandmother, she has to go out of town to get for training and stuff like that.
Mhm.
And if the company didn't reimburse her, then she could take it.
Yeah.
Okay, so,
100 miles.
employee expenses, tax, so you can no longer do the unreimbursed employee expenses, you can no longer do tax preparation expenses. So, and then like you were saying, the 2106, that's gone now. Dues and subscriptions, job search expenses, unreimbursed travel, and home office deduction are all gone. So. Okay, so, I doubt anyone will have to itemize, but you never know, so. What does the AGI stand for? Great job! Alright, you gonna keep going?
Yes.
Non-refundable credits. So there's two types of credits, there's non-refundable credits and refundable credits. And I'm gonna go through some of the biggest ones that we're gonna see. There's lots of credits, but these are the ones that we'll probably see. So credit for dependent and childcare expenses. This one's actually kind of one of the more difficult ones, because you actually have to calculate like the amount for this. It's not just a set amount. So this credit allows taxpayers to reduce income tax by a percentage of their total care expenses. Non-refundable basically means that it can reduce their income owed to zero, but they can't get a refund from it. So it can only bring you down to zero, it can't bring you down to getting a credit back. Can't result in a refund or reduce other taxes, so. It's 20% to 35% of the qualifying expenses. And it has to be for a qualifying person, so it has to be a child under 13, a spouse who's unable to provide self-care, and a dependent who's unable to provide self-care. So any expenses you pay for their care, you have to also just, I think I might mention this somewhere else, but this has to be so that you can work. That's actually something else. Hold on, we'll see. Let's go into it. So, yeah, so this has to enable the taxpayer to work, and you have to provide the name, the address, and either a tax identification number or a social security number of the care provider. So if you are paying a babysitter and you want to take this, you're gonna have to report, they're gonna have to claim that income. I've ran into that with people who pay someone and then they want to take the deduction, but they don't want that person to have to pay tax on it. And you can't have it both ways. So to claim this credit, you have to have a qualifying person, which we just went over, under 13, cannot provide self-care, dependent or spouse. Their earned income has to be, or they can't, you have to have earned income to claim this. I think that goes along with it's in order for you to work. Work-related expense test, and then joint return test. Oh, that's just the joint return is, once again, you can't have, the qualifying person can't not be filing a joint return with someone else for you to get this. And you have to be able to provide all the information for the provider. That makes sense.
One thing to add to that is, like a student taking nursing or something, they can take that credit. So the husband works, but the mom's going to school. That's the same as working.
Oh,
I think it's like $200 per month. You have to read for them. What I'm
okay.
talking about.
This is just a high-level overview.
Yeah. Well, I mean, you know, if you got two people, the wife
Yeah.
isn't working, but she's going to school,
And
and you
then
have
they
to have a
need care for
babysitter, then they're allowed some, it used to be like $200 a month. If she went to school all year, then her earned income was $2,400.
Okay,
See, okay.
I see what you're saying.
Okay.
Okay, yeah, they didn't go over that in the module, but that's probably important to know, because you probably run into that a lot. And all 5 tests have to be met in order to claim this credit, so. So credit for the elderly or disabled, we get this one a lot as well. This is a Schedule R that's gonna generate when you do this. It's non-refundable as well, so it can reduce the tax burden for people who are 65 years of age or older, unable to work due to a disability. They must be a U.S. citizen or resident alien, and they either need to be retired on permanent total disability, receive taxable disability income, which they'll have a form for that, and on January 1st had not reached mandatory retirement age. And there's a decision tree, this publication 4012 will ask you questions, and you can run through that decision tree to figure out if they can get this.
Quick question, I mean, the first is, to get it, you need to be 65 years of age or older?
Or unable to work due to a
And then the
disability.
bottom one, 3, it says on January 1st, and not reach mandatory retirement.
I think that's if
If they're disabled?
they're disabled.
We get very, very few of those.
Yeah.
They
It's
have to be
kind of-
really low income.
I've only had one work, and that was my uncle years ago. He worked for the post office, and somehow that worked out, but
Yeah, I think it's saying 20% not reach mandatory retirement age. So if you're, yeah, so it's saying if you're disabled and you're working, you can claim this, but if you've reached mandatory retirement age, you cannot claim this.
I think it'll work out on the form. But
Yeah, well, yeah.
It'll figure it out.
You've got too much income.
I'm just telling
Yeah,
you
yeah,
this
Most
is.
of the time,
Yeah.
that's very rare.
Very rare.
So these are some of the limits. You can't take this credit if your adjusted gross income is any of this, or the total of your non-taxable income is that.
Right there in that second column. It's what I'm not supposed to
Yeah,
do.
typically.
Mhm.
I don't know if I've ever had someone get this before.
I think I've had one in all
I've
the years
tried.
I've done it. So,
Definitely try.
yeah.
Take this credit, taxpayer must provide a physician's statement. It does not need to be submitted, but the taxpayer should have it. So that's, once again, that sort of burden of proof is on them. But if they say that they're disabled, we can take their word for it.
They just need to know if they get audited, they have to provide that.
Yeah. Yeah. And then the VA generates a form that will have it for them if they're disabled, like if the VA has determined them disabled, there's like so a lot of people will have that. And once again, that's a Schedule R. Okay, retirement savers contribution, this is also non-refundable, it's also known as savers credit. You have until the due date of the tax return to contribute, so I wrote that in there, so this year, people can keep contributing up to April 15th, 2019, and can get benefits from that. I have no idea why they allow that. Who's eligible? You have to be older than 18, cannot be a full-time student, cannot be claimed as a dependent, and you have to make less than $31,500. If single, 47,000, head of household, 62,000.
Not to take more time, it has to be earned income, right? I mean,
Yeah,
it has to be earned.
yeah. So basically, it's just trying to, the point of that credit is it's encouraging low-income people to contribute to a retirement fund. So,
There's one thing will knock that out.
what's that?
If, well, my husband and I, for instance, he went on retirement years ago. Well, I started putting money into that. I couldn't take it because he had got a pension.
Right.
And your pension will knock you out of getting that credit, so I thought, okay.
So yeah, this is just for earned income. These are some of the eligible retirement accounts. This is not all of them. Obviously, if it's something you've never seen before, you can use your resources to look it up and make sure it's covered. But the main ones are all included. Use your resources. So it can be 50, 20%, 10% of contribution amount depending on your filing status. And you're gonna have a form 8880 tax layer will generate that for you. And it will usually make sure they get this credit.
So the spouse has a pension, and the husband doesn't.
Credit for elderly and disabled, does anyone know what form that is?
The one you just showed.
No, that was the Savers credit. Yay, Skidmore. True or false, retirement savers contribution credit only applies to a 401k.
False.
Yay, great job. All right, so refundable credits, mainly, we're just gonna talk about the earned income tax credit, which we get a lot of that, a lot. Okay, so the EITC, completely refundable, so they'll get money back even if no tax is owed. The main factors are the number of children and the income of the taxpayer. So the maximum amount, so you can still get the earned income credit if you have no children, but typically you get much more if you do have children, so maximum amount of the credit. This is the numbers I had for 2018, but I mean, once again, that I may not have looked at the right thing, but this is what it said in the module, so. What that is. So to get this, you have to have earned income. It is in the name. Once again, that's, you know, money that you earned, not anything that just came through investments or savings. Been a citizen of the US or a resident alien. You have to have a valid social security number for yourself, your spouse, and any dependents. So that knocks, we get people who they can't take it because they don't have social security numbers.
So if you have a PTIN, you can't get it?
I don't think so. No, I know you can't.
That's what I was thinking.
It won't let you. So I guess there are resident aliens that have social security numbers, right?
Yes.
Mm-hmm. Yep.
So yeah, have to have a social security number, and your investment income cannot exceed $3,500. TaxSlayer will calculate the earned income credit for you typically, but just these are some things to know if they're wondering why they didn't get it, and it could be any of those things.
On that investment income, that would include rentals, if people have rentals.
Yes, so yeah, we talked about that earlier, so rental income, anything that's passive is what they call it, meaning you didn't have to go do anything is how I look at it when I'm trying to remember, so. Okay, there's no maximum AGI, there definitely is, if you're making too much money, and there's always people who make like $100 more and they don't qualify for it, and they're usually very upset, so, but that's the name of the game. All right, so tax benefits for education. You're gonna see these a lot. So education credits reduce the amount of tax due. There was a tuition and fees deduction, that is gone now. I don't know if you all remember that, you used to be able to deduct whatever you paid in tuition and fees. Now the only benefit you can get for education are the American Opportunity Credit and the Lifetime Learning Credit. So that is gone now, that deduction. So if they come to you, they have a 1098-T or an account statement from the school, then you're gonna wanna make sure that they're hopefully getting one of these, or at least that they're eligible. And they might not be. So an eligible student, we talked about this a little before, it's the taxpayer, the spouse, or a dependent who is enrolled in one or more courses as an undergraduate or graduate. An eligible student differs depending on which credit we're talking about, so I'll get into that. This is a 1098-T, if you've never seen it. We get a lot of these, so you'll have payments received, and you can there's a place to input everything that's in a 1098-T in TaxSlayer, so shouldn't have any issues with that. So to claim education credit, cannot be claimed as a dependent on someone else's tax return, cannot be married filing separately, I mentioned that earlier. obviously their AGI has to be below the limitation, and they cannot be resident aliens for any part of the year, so you have to be a citizen. So the American Opportunity Credit, qualified expenses, tuition fees, books and supplies. Qualified expenses in reference to education does not cover room and board. And in fact, if you're getting extra money for room and board, you have to, that's income. So keep that in mind. Max credit of 2,500 per eligible student on 4,000 of qualified expenses. 40% of the credit is refundable, but then the other 60% cannot give you a refund. And can only be claimed for 4 tax years. We run into, I definitely maxed that out a while ago. I haven't been able to claim this in a very long time. So, and they must be enrolled at least half-time. That's a really important thing for the American Opportunity. The lifetime learning is easier. Oh, we cannot have a felony drug conviction. They can't have that either to get FAFSA, so I think it's just something to do with the federal education guidelines. You're filing separately, can't have it.
Can I ask you one quick question, go back?
Yeah.
We say maximum credit of 2,500 per eligible student of 4,000 qualified expenses. The next one says 40% of the credit refundable.
So, like, to get the full 2,500, you'd have to have spent $4,000 on qualified education expenses to get the max 2,500.
But then
So-
40% is,
So 40% of the 2,500 is refundable. So if your tax burden is at 0 right now, you can only get 40% of that 2,500 back as a refund.
okay,
Does that make sense?
yeah.
But if you had more than that,
Got
then
more
you
than
could
that.
take you could lower your tax basis
If you
and
pay
get a
taxes.
refund. Yeah. Okay, lifetime learning credit, so this is non-refundable completely. Covers undergrad, grad courses, and then courses to acquire and improve job skills, which a lot of people can take this. This is a good one. Max credit of 2,000, so the max you could get was 2,000, and you would have to have spent 10,000 on qualified expenses. 20% of expenses until the limit is reached. So if you had 5,000 in expenses, you would just get a credit of 20% of that 5,000, basically. Must attend an eligible institution, only tuition and fees, and in this case, books only apply if you have to buy that book in order to enroll. So books do not apply to this qualified expenses for the lifetime learning credit, just the fees for the course. And then if you have multiple students, you can combine those expenses to reach the max of 10,000. So it's 2,000 per tax return, not 2,000 per student. That makes sense. And they could be less than a half-time student. They could be enrolled in 1 credit and it would be fine. Or they don't have to even be getting credit for it as long as it's like a continuing education. Any questions about this one? No? Cool. All right, grants and scholarships. So this is a confusing aspect of it. I'll just plug in the 1098T and hope that everything shakes out the way it's supposed to. So scholarships and grants are taxable income when used towards living expenses. I mentioned that. And the amount of scholarships and grants that exceed expenses is reported on the 1098T for the most part. I haven't have you all run into much of this?
When you have scholarships on your 1098T, it'd be on a different line.
Yeah.
What we do is, say you paid 10,000, you got a grant of 4,000.
Right.
Well, we take the 6,000 and.
The 6,000 is what yes, you have to deduct the amount of scholarship that you get from the amount that you paid towards the institution. But the 1090, the tax layer will work that out if you plug everything that's in the box into on the 1098T. But, I don't know. And then, the kiddie tax, is now within scope of VITA, which it wasn't before. I don't know. So I don't know that we're gonna have a lot of kids coming in here that have investment income of more than $2,100 a year. But if you do, there is this Form 8615, and I'm sure TaxSlayer asks you if any of your Does it ask you if your dependents have any unearned income? It does, right? It should prompt you for that.
Yeah, ask something about.
So, but it can include scholarships and grants. Honestly, I didn't understand this 100%. Yeah. I tried to understand what they were saying, but, basically they're saying that part of scholarships and grants could be considered unearned income under certain circumstances. But it didn't really delve into what those circumstances are. I guess if they got, a scholarship that covered room and board.
But if they're being claimed as a dependent, I don't know why that would come under kitty income.
I know.
Now, my daughter got a scholarship when she was at a private school for reading so many books. She got a scholarship for like $250.
Yeah,
So maybe that's what they're,
yeah. So something like that.
And there's some people that get, full, tuition assistance and get scholarships. So that scholarship is their money to keep, so would that be considered?
Yeah, I think. Also kitty tax, I think you have to be under a certain age. So I think that's what it is.
17, is it?
Yeah, so a college student typically is not going to run into this. This is what
Right.
Gail was saying, like, if a kid got a full ride to a private school and they're under 17 years of age, if their room and board is being covered, that would be unearned income. Thank you. Yeah, does that make sense? Because, yeah, the kitty tax,
Because that goes in and it taxes at the parents' tax rate, I think.
because it came in her name.
okay.
It wasn't in ours, it was in her name.
But you wouldn't have had to claim it because it wasn't over 2,100.
Yeah, not the
Child's
250,
net unearned
right.
income exceeds the threshold, it's 21.
Because I know there's more than that other schools do, for just, just for people, just incentives for them to do things.
So I guess if they had sent her 2,500, then she would
Right.
have to claim
Yeah,
it as
yeah.
her income.
Okay,
Exactly,
so
yeah.
if they're
Right.
over 18, scholarships don't count, is what I'm reading. I don't think we're gonna run into this.
I think it looks like it's 17 is the one
Yeah, I think
marker,
this is it.
2,100 is a one marker. And then the question is that, I mean, it's basically, I think, babysitting and, that kind of what, people under 17 get that kind of income,
Yeah,
And because if
but
somebody,
that would be earned income, so it wouldn't even, this is unearned. This is like, really, this is just so people can't put investments in their
Into-
little kid's name and then not have to pay tax on it. That's all that this is really here for. But then they changed it this year to include a
scholarship.
scholarship amount for under
But then
17.
get that, most of it should be over 18, I guess, to really,
Yeah.
to get,
But then scholarship amounts don't apply if you're over 18. Because that would be insane, people would be paying so much money. Parents would be having to claim their kids getting scholarships at college, I think that would be.
I guess there are like those gifted camps, they give scholarships to some kids to go to those. So that would probably be within that, because they would be under 17.
Which is a shame, because it's meant to keep people from being able to not
Mhm.
put stuff in their kids' names, so now kids that are benefiting from it, their parents have to pay taxes.
Yep.
Whatever, I don't make the laws, maybe one day.
Ignorance is bliss. What we don't know won't hurt us.
they're just
Okay.
making sure the kids pay it now, so when they, still 21 trillion in debt, so better pay now, kiddies,
Yeah, get it out of them while you still can. Great. So real quick, before we get into Affordable Care Act, finishing the turn, you're gonna look over the intake form once again when you're done, make sure everything's checked off, review all the documents they gave you, make sure you entered everything. Sometimes they'll just hand you a pile of stuff and you might miss something, so you wanna go through that once again at the end. A lot of people bring last year's tax return with them, which is nice. You can compare last year's to this year's, see if anything jumps out that there's a huge difference, because that's usually a red flag, because most people, it's about the same thing every year.
I had one interesting case last year, this gentleman came and had a lot of interest income, right? So, and when I filed it this year, he said, I got more money last year. So I said, who filed it last year? He said Jackson Hewitt, whatever it was. So I looked at his, I said, why don't you bring your stuff last year? And I look at it. So I looked at it last year interest, and this year's interest. Except God knows what the guy did at Jackson Hewitt.
Yeah,
He forgot to add all of them. He had a number for interest income that probably came from the air, you know?
yeah,
Because I added it all up, and I said, look, he understated your income last year. And, so based on this, he got a $400 return from last year. So based on this,